Here's what you may have missed last week in markets. Before we dive in, make sure to follow our page to stay up to date with the latest market news and financial planning trends here in Canada. The biggest story from last week was the SpaceX IPO, marking the largest IPO in history. The stock, which had a $135 offering price, hit the market midday Friday and quickly surged as high as $176, bringing the company's valuation to over $2 trillion. The deal was heavily oversubscribed, about 3 to 4 times, with a lot of demand coming from retail investors. There's clearly a lot of excitement around this, and the long-term opportunities are significant, including communication, infrastructure, defense applications, and future space-related ventures. The IPO is a great sign of strength in markets, because we wouldn't see an IPO like this or this level of demand in a weak market. So what you're seeing is a lot of momentum and a lot of FOMO. Right now, a lot of investors are buying into the growth story and the Elon Musk halo effect. However, the company is not yet profitable and isn't expected to be for another few years. So investors should be a bit cautious, because while the hype is real, so are the risks. Historically, large tech IPOs have seen drawdowns of 50% or more in their first year. And at current levels, SpaceX is trading at roughly 100 times price to sales, significantly higher than companies like Nvidia, Tesla, or Alphabet. So buying a large share right now off the bat may not be necessary or appropriate depending on your portfolio. Many investors may also gain exposure without even needing to take on a large position, because SpaceX is being fast-tracked into major indices. It's expected to be included in the NASDAQ in just a couple of weeks after going public, which means many investors may end up owning SpaceX indirectly through ETFs or index funds. This is a great example of where professional advice really matters, because it's not just about chasing opportunities and doing what's hot in the market right now. It's about understanding how new additions like this fit into your overall portfolio. On the geopolitical side, we saw some positive developments. Over the weekend, it was announced that the US and Iran had reached a deal. That helped reopen the Strait of Hormuz and led to the US ending its naval blockade. Markets responded positively, and oil prices came down. We're seeing oil prices fall to about $80 a barrel. And while this is very positive for the markets, before this conflict escalated, oil was closer to about $60 a barrel. So it may take some time before we see prices fully recover. Last week, we saw US headline inflation rise from 3.8% to 4.2%. While the numbers show a spike, when you break it down, much of that increase was really driven by energy. Core inflation, which excludes those energy prices, rose from 2.8% to 2.9%, which is much less significant, and what's important is that it came in below expectations. This shows us that inflation hasn't broadly spread across the rest of the economy yet. In other words, oil was the main driver of this increase. And if oil prices continue to come down with the new agreement in place, that inflation spike could be short-lived. We could also start to see inflation trend lower again in the coming months. Expectations for rate hikes have softened. Markets are expecting the Fed to hold rates steady at their June 17th meeting, similar to what the Bank of Canada did last week, where they held rates steady at 2.25%. The Bank of Canada Governor Tiff Macklem suggested that the path forward still remains uncertain. Higher oil prices can slow growth and contribute to weaker GDP, which would support rate cuts in Canada. We already saw Canada's GDP come in negative for 2 consecutive quarters, marking a technical recession. At the same time, oil price increases push inflation higher, making it harder for central banks to ease. That's why we're seeing a more complex environment, where weak growth alone may not be enough to justify cuts. This is why it's so important to have an active portfolio strategy, one that has a plan A, B, and C, and can actually adjust as markets change. Because markets don't move in a straight line, they react to new information quickly. And your strategy needs to be able to do the same. If you're in mutual funds, ETFs, or a strict buy and hold approach, there's a risk that you're not actually managing the risk of what's happening underneath the surface. Another story that didn't get as much attention is around North American trade. The US confirmed it will not formally renew the Canada-US-Mexico agreement at the July 1st deadline. While it won't be renewed, the agreement itself isn't going away and is expected to remain in place for years. Instead of a simple renewal, we're likely moving into an ongoing, year-by-year negotiation instead of a full extension. The change in structure will create some uncertainty, especially around key industries like autos, steels, and manufacturing. At the same time, most goods are still expected to move freely under the agreement. This is likely an opportunity for renegotiation of certain areas in the agreement, which is why we'll be paying close attention going forward. This is exactly where working with a professional makes a difference, because it helps filter what actually matters versus what's just noise. Overall, there are many positive signs driving markets higher, whether it's capital markets, easing geopolitical tensions, or strong company earnings. This is a great reminder of the importance of staying disciplined and focusing on your long-term plan. Because the investors who do best over time are the ones who stay consistent, well-diversified, and aligned with a clear strategy. If you're not sure how your portfolio fits into this environment, or just want a second set of eyes, it's always worth having a conversation. Sometimes a quick review is all it takes to give you more clarity and confidence moving forward, so feel free to reach out today.